You know, it is genuinely wild to watch a company post record profits and then instantly watch the market just, well, vaporize 20% of its stock value in a matter of minutes. Welcome to Earnings Unscripted. It is May 26, 2026, and today we are unpacking Zscaler, ticker ZS, and their Q3 2026 results. And wow, Miro, the after-hours tape on this is just brutal.
It really is. It closed regular trading around 184, looking perfectly stable. And then the minute the print hit, it basically fell straight off a cliff down to the 140s. But look, the market is ruthless. It does not care what you did yesterday.
Right. And speaking of ruthless, quick reminder that this podcast is just our personal opinions, definitely not financial advice, so please do not base your trades on our banter. But getting back to that tape, I mean, on the surface, the numbers look like a completely clean beat. Revenue came in at $850.5 million, so that is up 4% from last quarter and 25% year over year.
Yeah, and they actually posted a record non-GAAP operating income, $195.8 million. That gives them a 23% margin. Net loss narrowed, and non-GAAP EPS was 1.08. On paper, it looks like a highly profitable cloud security machine.
True. And they do cloud security differently for anyone not totally familiar. It's not about firewalls for them. They use this zero trust exchange to actually hide user data behind a secure proxy, which is obviously a booming business. They even shared this wild anecdote about a fintech company using Zscaler to hunt down employees who were secretly using unauthorized AI chatbots, just catching shadow AI in real time.
That is a great story. But the real problem is Wall Street completely ignored it. They only looked at the guidance. The headline beat totally masks the fact that management threw a massive bucket of cold water on the next fiscal year. They projected 2027 revenue and ARR growth to drop to just 16 to 17%.
Jeez. Okay, and they have been cruising at 25% growth, so that's a really sharp deceleration. The market is essentially resetting their entire valuation multiple on the spot.
Exactly. The core engine is slowing down. You also see it creeping into the free cash flow. That dropped almost 20% quarter over quarter to $136 million. They're still securing huge deals. I mean, they had an 8-figure upsell replacing legacy firewalls across 2,000 healthcare clinics. But management is openly blaming this overall slowdown on a weakness in landing new logos. Plus, 2 of their top sales executives just walked out the door.
Oh, wow. Okay, losing sales leaders at the exact same time your new customer pipeline stalls out. That is definitely not a coincidence. And I saw another completely bizarre detail in the CapEx outlook. It looks like they're getting squeezed by the broader AI hardware shortage.
They absolutely are. Management basically admitted they're pulling forward their data center equipment orders to Q4 just to lock in today's prices because they expect hardware costs to completely surge next year.
Wait, hardware inflation directly squeezing a software business margin? That's a dynamic you don't hear every day. All right, let's actually open that up because I want to get into the details of what the sales shakeup and these rising data center costs really mean for their trajectory.
Yeah, the hardware side is honestly fascinating because you usually think of these cloud security players as, entirely immune to physical supply chain issues.
Right. They're supposed to be asset light, just lines of code and gross margin.
Exactly. But the Zero Trust Exchange actually requires a massive data center footprint. And the CFO, Kevin Rubin, essentially admitted they are aggressively buying up equipment right now where they can get it, just to, quoting him here, lock in today's prices ahead of potential increases in the future.
So they are panic buying servers. That is amazing. Everyone is hoarding GPUs, and now Zscaler is forced to hoard the networking gear just to keep up.
They kind of have to. They expect CapEx to jump up to 200 basis points next year, which obviously eats straight into free cash flow. But what really gets me, the thing the market is really punishing them for, is the internal disruption.
The sales shakeup.
Yes, because if you read between the lines on that terrible 2027 guidance, they are trying very hard to spin it, Rubin called it a tempered approach to new logos. He basically said, it's just reality that when leaders depart, you might see disruption, so they're taking a prudent approach.
Prudent. I love that word on Wall Street. It almost always means we have absolutely no idea how messy the transition is going to be.
Roughly translated, yeah. Mike Rich is the chief revenue officer, and losing two top guys right beneath him at the end of a quarter, you just do not see that if the new logo pipeline is healthy. You do it or they leave when things are stalling out.
Okay, but hold on. If new business is stalling, how are they still generating $166 million in net new ARR? Somebody is paying them.
Well, this is the magic of what they call Z-Flex.
Right. I saw that in the notes. Over $480 million in contract value this quarter alone.
It is a massive number. Z-Flex essentially gives multi-year customers the flexibility to swap different security modules without triggering a new procurement cycle. So if you bought one tool, you can just pivot to another feature inside their ecosystem without going through legal or budget reviews again.
Oh, I see. It is like having a streaming bundle. If you get bored of one channel, you do not cancel the whole subscription. You just flip to the movie package.
That is a perfect way to describe it.
It feels like total flexibility to the buyer, but for Zscaler, it just completely masks the lock-in.
Exactly. It keeps their trailing contract value sitting pretty above $1 billion. It makes up upselling almost frictionless, but it also obscures the fact that the core engine, bringing totally new companies into the fold, is misfiring. They're just monetizing the existing base better.
Okay, so you have stalling new logos, hardware inflation, a disrupted sales team, and yet they just announced they're buying Symmetry Systems? What is the strategy there? Because that does not sound like a company hunkering down.
It's actually incredibly smart. They're looking past humans entirely. Jay Chowdhury had this fantastic line on the call. He said, "Today, users are the weakest link in cybersecurity. Soon, AI agents will be the weakest link."
Wow, because they operate autonomously, right? Like making decisions at machine speed.
Right, with far less oversight. Zscaler is basically saying the old model of just building a wall around a human logging in from a laptop, that is over. They need to build an access graph to monitor how one AI model talks to another AI model inside your corporate network.
That is, mildly terrifying from a structural standpoint. Machine-to-machine security.
It's agentic security. It's absolutely the only way forward for the industry. The problem is, actually, no, the reality is it doesn't fix their revenue problem for 2027. Symmetry is bringing in an immaterial low single-digit ARR right now.
So they have the long-term vision completely dialed in, but they're sort of tripping over their own feet in the short term, which kind of brings us right back to that brutal stock reaction. So where does this actually leave them as they try to rebuild trust heading into next quarter?
Well, it leaves them in the penalty box for a while. The market is basically demanding proof. Look, the Q4 guidance itself is actually fine. They expect roughly $875 million in revenue,
which is still about 22% growth year over year. So the roof is definitely not caving in tomorrow.
No, the core is incredibly profitable. They are forecasting operating income to jump around 30% next quarter. But they really have to prove they can execute down market.
Right. Though I did notice the CFO trying to do a little damage control on the call. Kevin Rubin specifically said he was not trying to suggest new logo growth is tempering. He was just taking a tempered approach to his own expectations.
Yeah, the word tempered was doing a massive amount of work in that sentence. But it just means next quarter, the street will strip out all the M&A noise. We need to see their net new ARR excluding that Red Canary acquisition. If organic growth stays flat, the valuation penalty sticks.
You just cannot buy your way out of a sales rut. But zooming out, it really feels like Zscaler is caught between two eras right now. They are building this wild, futuristic, agentic AI defense system, yet they are getting completely derailed by traditional problems.
Physical server shortages and broken commission plans.
Oh, sorry. Yep, exactly. Basic meat space problems. The visionary roadmap only buys you patience if the actual human sales team is hitting quota today.
That is the whole story. Technology evolves, but corporate incentives never really do. I think until they stabilize that sales floor, Wall Street is going to largely ignore the AI access graph.
Completely fair point to land on. Okay, I think we have successfully autopsied this quarter.
Yep, we will see if they manage to hire a new sales VP before the next print.
Let us hope. Thanks for thinking through the numbers with us, everyone. We'll catch you next time. If you like catching these quick earnings breakdowns, feel free to just give the show a follow so they pop right into your feed. And as a quick aside, we do use AI tools to generate the scripts in Voice's ear, mainly because it lets us compress those massive corporate filings into something you can actually digest on your commute. We'd love to hear your feedback or any ticker requests, so just shoot us a note at earningsunscripted@datamadness.ca.
Talk to you next time.